Well, Lyft shares are falling after reporting a loss of more than $1 billion in its first quarterly report as a public company. You can see shares down just over 7% so far. But despite the significant loss, Lyft's CFO says that the company, quote, sees a clear path to profitability. Joining us now is Santosh Rao, head of research and partner at Manhattan Venture Partners and also an early investor in Lyft. Santosh, thanks so much for being here today.
Thanks for having me.
Taking a look at these numbers, it was a huge loss for Lyft, but revenue was up 95% year over year. Number of active riders was just around 20.5 million. Were you impressed by these numbers?
Yes. As a long-term investor and as an early investor, I think the numbers were great. Off the gate, they beat on every metric. And the guidance was also, it's pretty much a beat and raise quarter in a traditional sense. So I think this was a great quarter. The losses were pretty much telegraphed. I mean, it wasn't a big surprise. Yes, on an ongoing basis, the losses were reasonable. That came in below expectations as well. But when you factor in the options and all that, which is fair, I mean, you need to include that, the losses came in higher. But as they said, the flip side to that is they said this is the highest or the most expensive year. Rather, they're going to get all the expenses in 2019, and then going forward, the expenses are going to be more controlled. So I think that's a good sign. So that's an offset to a high loss this year, this quarter. So I think overall, net, I think it's a good quarter. The tone of the quarter was very good. The company's moving in the right direction. And as a long-term investor, I think I'm happy with the way it's going.
When we take a look at how the stock has performed since it went public back in March, it's been under a significant amount of pressure. As an early investor, one, did you expect this? And two, what do you attribute it to? Does a lot of it have to do with the upcoming Uber IPO?
Yes. You mean the sell-off?
Yes.
Uber. Yeah, that's a big thing. I mean, that overhang was always there. So I thought it was a very good strategic decision to go first. And we said that at the time. So they went ahead and pretty much defined the market and set the table for Uber. And they got whatever they want. And in terms of getting the price, we always thought that 60 to 65 was the right range. They should have gone in there. When we initiated coverage way back in December, we thought that was the right price. Close to 20 billion valuation overall on enterprise value. But I think the IPO pricing is always, like they say, it's more an art than science. The demand was very strong. The supply is limited. The float is low. So you see these swings. So they went a little overboard. But as far as the company is concerned, they did well. It was a liquidity event, and they cashed out. I mean, they got as much as they could. The bankers did well for the company. The early investors are pretty much traders in the IPO. Long-term investors don't get in on the IPO. They need the dust to settle a little bit. So I think for traders, there's a little loss. But I'm sure in the long run, if they stay there, they'll make up that money.
So Lyft is more of a singular focused company, really focused on ride sharing, whereas Uber is more of a platform. And as Uber Eats, it's also dabbled in a couple of other divisions. Just in terms of how they stack up, would you say that Lyft has the upper hand? I mean, it's going up against a giant that's a lot bigger than them.
Yeah, so we need to break it up a little bit.
Yeah.
We invested in this because of their pure play business model. That's their edge. And North America is where the ride-sharing market is. Rest of the world is there, but this is where it's really at. It's a $1.2 trillion market, very early in this whole process. So they have a long runway ahead. It's going to be a duopoly with a 39% market share for Lyft and 69% for Uber. I think it's a healthy duopoly. The market's going to sustain both. It's not a zero-sum game, so they'll both thrive here. Uber is big, but if you really look at their U.S. part is only about 2 times or maybe 3 times bigger than Lyft. Most of their gross bookings are outside the U.S. So I think you really can't really do apples to apples and just take the absolute numbers. On a U.S. basis, I think they compete very aggressively, very evenly. So I don't think that's a big threat. The size is not a big threat.
Santosh, earlier this hour, Wall Street Journal was out with a report saying that Uber is set to price its IPO at the midpoint of its target range or below. When you take a look at what we should expect from Uber when it does make its public debut at the end of the week, what are you looking for?
Yeah, this might be something like Pinterest did. They priced lower and they just shot right past the range. This could be one of those things. The bankers are managing expectations. But then there's this downdraft of the strike coming in, the whole market selling off. I think there's all that cross current going on. So there's some real headwind there. So I think the bankers are being very reasonable. But we'll see. You still have tonight. So we'll have a few more hours. They'll price it tonight. So by the end of the thing, they might get the right price. I mean, from last night, what I heard was they might price at the high end or maybe slightly higher. So I guess things change because of some sentiment here and there. But let's see. It's too early. Till the last moment, you don't know. It's more an art than science, like I said. So hopefully they'll come closer to the higher range.
Santosh Rao, thanks so much for joining me today.
Thank you. Thanks for having me.